Brilliant. Okay, well then we will. Oh, I can see someone's audio is loading. We will kick straight off. So hi everyone, thank you so much for joining us today. I am Holly Hudson. I'm the community lead here at VenturePath. So today we're going to be talking about investor readiness, specifically a guide to smarter and more efficient fundraising. Before I hand over to Ian with the lovely red background, probably going to waving in on your screen, I wanted to just take 30 seconds to tell you a little bit more about VenturePath. So at VenturePath, we've built a community, a growth investment community for UK tech founders, giving you the content, the capital, the connections that you need to grow, raise investment, and then scale further. So we work one-to-one with all of our founders on business growth planning, providing you a kind of personalized growth plan to help you achieve your goals. So we have 100 hours of learning content on the platform, on-demand training videos, in-person and virtual events, just like you're on today. We've built a community of fellow founders, exited entrepreneurs, scale-up experts, strategic partners, all of which are available for you to tap into should you wish. And last but not least, we have capital. So we support all of our founders with investment strategy and deal making at Series A and Series B. So founders who are looking to raise anywhere between 2 and 20 million. And we have 6 billion of venture funding available from our VC partners within the community. So thank you everyone again for joining. I hope that today is going to be a good session for you. It's exactly the kind of one-to-one, it's exactly the kind of support that we offer to all of our VenturePath founders. So if it is the kind of support that you're after, then I'll be in touch after and we can have a follow-on conversation. But 2 minutes on housekeeping. We're recording this session, as I've mentioned. It's purely for our internal purposes and won't be kind of shared widely. It's super interactive. It's a smallish group today, so feel free to raise your hand, pop any questions in the chat box. Ian we've got kind of time for Q&A at the end, so he will make sure to address them then. So yeah, over to you, Ian.
Excellent. Thank you, Holly. Thanks guys for tuning in. This is something we do every couple of weeks for people who are maybe considering fundraising, considering where that's going to feature in their businesses plans. By way of sort of very brief introduction, I've been an entrepreneur. I've done that whole thing. I've raised VC funding into my business. I grew it through 5 acquisitions and sold it to an international trade buyer. That then moved me into investing and advising, which I've done for the last decade or so. And I've worked with over 60 companies on their Series A fundraise, their first VC fundraise, and helped those companies raise over $1 billion of funding. So hopefully some of what I'm saying is going to be useful to you. And if I can kind of save you some of the learning on the job, that painful experience, then that can only be a good thing. There are basically 3 things I wanted to talk about today in this context of investment readiness. I'm really sort of thinking about how to approach VCs. And all of this is going to be relevant if you are a UK tech company, $1 million-ish revenue. And you might be a bit before that, planning ahead. You might be a bit beyond that and thinking about the timing of your fundraise. There are the 3 themes are basically the nuances of raising Series A. So how it's different from seed funding. Also talk a little bit about how you can spend your time best in what is potentially quite a disruptive and distracting activity of raising funds. What's the best use of the founder's time? And finally, how leveraging community can get you your end result quicker and more easily. So that's the 3 topics. As Holly says, interrupt me as you go, drop your questions in the chat, I'll try and mop them up, or we can pick them up at the end. So the first thing I would suggest that you guys give some thought to is, if you've raised previously, if you've raised a seed round, pre-seed, seed round, you might think, actually, I've sort of figured it out now. And in my experience, that isn't the case, because the activity involved is quite different from stage to stage, which is completely unhelpful and unfair, right? But it is like learning to ride a bike and then learning to drive a car. They're different things. So at seed stage, you will be dealing with the investor. I'm an angel investor in a number of businesses, about 17 or so. And in those instances, I've backed a founder and they've told me a good story and I've thought, yep, sounds interesting, sounds plausible. I like the people. Yep, I'm happy to do this. That is completely different with a VC fundraise, because with a VC fundraise, you're not talking to the money. You're not talking to the person with the cash. You might be talking to the VC fund that has money available to invest, but it's not their money. And that is the main key distinction, that a VC, a venture capital firm, raises money into a pot, and that pot, they're then given the rules to their investors of what it is they're going to invest in. And that means that it's harder to say, I know we don't have all of these proof points, but come on, I'm a good person. You know, I'm going to work hard and I'm going to make this a success. Whereas you can have those kind of conversations on a more human level with your seed stage investors, with a VC audience. They want to see more proof, more data, more evidence, and less gut feel. Another key thing that links to that is because they've already told the investors in their fund, the money that's come into the pot they're looking after, they've already told those investors what it is they're going to be investing in. And that might mean that they're focused on life stage. We're investing in companies with $1 million+ revenue, with a sub 12-month path to profitability, with a pre-series A stage, with a pre-series B stage. So they'll have a very clear set of criteria by timing, by life stage, but also they might have focused on subsector. We're a fintech investor, we're an insurtech investor, we're an ad tech investor, and they might have focused on geography. We're focused on a particular region. And so with all of those nuances, you can actually, if you do some homework, you can begin to focus the outreach that you do on investors who are structurally able to say yes, rather than trying to reconvince a different VC firm to change their story, to change their thesis. So that's definitely worth thinking about, because again, at seed stage, you might be able to convince your angel, look, I know you've not ever done anything in climate tech. It's quite a new and emerging area. I understand why you haven't. This would be a really good first investment for you to make in this sector because of my relevant CV, our early traction, the partnerships we've got. Whereas a VC won't be able to as easily make that shift from their sector or area of focus to your area of focus. So think that through, because you're constrained there. That isn't something that there's going to be a lot of flexibility on. A third nuance of raising at Series A is this greater proof points. So at seed, you will say, look, I've done some homework, I've done some market research, I've even spoken to some customers. We've got some customers, and they kind of like what we're saying and doing and selling, and that's a real positive. And that's the time for your seed stage investors really to make a decision. They might want to speak to a couple of customers, but there's not a lot of data to assess. Whereas once you're at that sort of $1 million+ revenue threshold, kind of entry level for most VCs, you have got that data in the business, you have got greater proof points, and you are able to be scrutinized, whether you like it or not sometimes, right? And so being able to demonstrate that you've already got some really strong proof points and evidence, and in practice, that might be the difference between saying, I know that this market's growing. I feel we can make a real impact here, and I think we can grow our revenue to 10 million in the next 2-3 years. Replacing that with the evidence shows that this market is growing at a compound annual growth rate of 25% year on year. Our customers are telling us that the solution we're providing is best in class, and one that they're willing to create a new cost line for, or ditch a competitor and switch to us. And our research into our prospects and pipeline indicates that this trend is only going to grow. Now you see how you're kind of saying the same things, but you've removed phrases like I think, I feel, I hope, and replaced them with the evidence shows, the data proves, our customers are telling us. And that point of adding extra confidence through extra proof points is a key point of distinction with the VCs will look for. And then my final one on the main changes is your sales plan at seed is always going to be a hockey stick, right? We're low now, but we're hopeful for the future, and over time it's going to be a great success. Whereas at this point, that's kind of the approach to Series A, you're going to have the data in your business about the sales cycle, about the average order value, about the churn rates, and all of that activity, all of that data is real. It exists in your business, right? We can look at your last month of trading and look at your unit economics. We can understand your growth rate over the last 3 months, 6 months, 9 months, 12 months, which is good and bad, right? Because it might be that you've felt under-resourced, cash constrained, and therefore your growth has been slower than you predicted. But unless you've got a clear story for new investors about how the investment is going to create a step change, is going to create a real moment of difference in your business, then the challenge is that your investors are going to think, that's great. You're going to reduce your sales cycle from 12 months to 6 months. You're going to double the basket value, the average order value. You're going to reduce churn. But all of the evidence over the last year or two it doesn't give me that comfort. So really being prepared to be able to defend the data that you've got, particularly commercial, and share the confidence with your impending VC, your hoped for VC, about the predictability of sales. And sales predictability is obviously ridiculously hard, right? If I bet, what is it, 22nd of November? I bet not all of you know where this month's revenue numbers are going to end in the next 8 days, right? It's difficult because sales come in, sales slip, sales move. But by having some degree of confidence around the predictability of revenue, it's kind of what VCs are looking for. And I will just add a little word of caution there, is often we'll speak to founders who initially think, but I need to raise my £3 million, £5 million, £7 million, whatever the number is. That isn't the VC's job to solve your funding crisis, right? They're looking to back winners that will deliver a great return for their fund. And so being able to demonstrate to them that your business has got winning characteristics, you've created some data in the business, you've understood it, and you understand that there is an element of risk, an element of a leap of faith, but you've reduced it and made it as comfortable as possible for an incoming VC, is a better way of getting them on side, rather than just kind of arguing back with them about, I know our data wasn't very good, but in the future it's going to be better with your money. So they're probably the 4 main points I would say are most markedly different from any fundraise that you've done before. So with all of that going on, where do you spend your time? And having been a founder and having fundraised, and then having subsequently advised lots of founders on fundraising, it is a thing that takes up a lot of time. And so something needs to give, because otherwise what happens is, at the point you're courting your VC, or VCs plural, because you ideally want to get multiple offers so that you've got some competition, some competitive tension that keeps the VCs on their toes and helps you when you're negotiating back with them. Then when you're trying to get all those guys interested, the challenge there is that if your business is slipping, if revenue is dropping, because normally you're quite involved in revenue, if customer churn goes up a bit because you're not keeping a close enough eye on it, then all of these things are really bad issues for a VC. They're red flags. Right? So I'm looking at your business, you're telling me it's great, and you're telling me it can grow to a really big business, and yet you've just lost a major client you weren't expecting. You had a 90% sales prospect fall to 0 because they bought elsewhere, and your CTOs just handed their notice in. That's not a great backdrop for raising money, right? So if you're going to have to juggle what it is you can do versus what it is your team can do, and hopefully there is a team around you by the time you're sort of approaching Series A to give you some support. Now, they don't need to all be full-time. I've been there. You can't afford them all full-time, right? The best people are expensive, but it might be that you can bring in some non-execs. It might be you can lean on some advisors. It might be that you have got people in the team you can delegate aspects of the business to. It might be that you delegate parts of the fundraise, or it might be that you delegate parts of the operational side of the business, or it might be that you delegate commercials. So, client management moves over to a team member for a 3 to 5 month period while you're getting the funding over the line, so that things aren't forgotten, lost, dropped in the cracks. The next piece around resourcing your business with proper support as a sensible thing that you as founders can do in advance of a fundraise is then preparing a well-constituted set of documents in advance. And this isn't the most fun in the world, right? So this isn't where you guys think, what I'll do is work on writing a business plan or more assumption setting in my financial model. These aren't exciting things that get you out of bed, but they are the things that we would suggest are going to help you spend your time better in the fundraise process, because quite simply, your ability to produce in advance a teaser, so an exec summary as it's otherwise known, a 1 or 2 page summary of your entire business, including its growth story, its growth plans, and the investment proposition. A quick kind of word to the wise there, I would always produce that document last, because writing succinctly is hard. Once you've done all of the other work on financial models, pitch decks, and business plans, condensing that down into a very short teaser is quite an easier way of approaching it. Now, the reason for that teaser is to get no's, and if you think of it like that, it sounds a bit upside down. But if your job with the teaser is to qualify out VCs who could never invest in your business because you're not focused in their geographic region, your sector is different to the focus that they've got, your ticket size, the amount you're raising doesn't fit with their fund's objectives, or they've got a portfolio conflict, they've already invested in a competitor and therefore they couldn't invest in you. If you can get those answers on the back of a 1 or 2 page document in the hands of the relevant VCs, that's quite a useful safeguarding of your time. And it can feel awkward. We always describe it when we're helping clients raise their funds, that you're going to get a week or so of rejections. Just be ready for rejection week. Right? It's painful, but you can take a hit list of 40 and turn it into a hit list of 20, in a matter of days. And there's a point that you kind of got to hold your nerve through that, because that's 20 people telling you your baby's ugly, which you don't want to hear. But the reality is that then means that you've moved to the next 20 who have said, you know what, I kind of like this. There's no structural reason we couldn't invest. Now tell me a little bit more about your go-to-market, your product roadmap. Tell me a little bit more about your exit horizon. And now you're into detailed questions that are essentially buying questions. And if you think of the investment process a little bit like a campaign, a sales or marketing campaign, there is a process. There is an element of courtship. There's an element of getting them enthused. There's an element of negotiating terms. So it is a bit like the sales stuff you do day in, day out. It is a bit like running a marketing campaign. So actually getting to the point that you've qualified people out of the funnel who are never going to buy and never going to be your target investor is quite a useful discipline. So that is the job of the teaser. We would add to that then a business plan. And for VenturePath members, it's obviously a membership community that Holly was talking about. We provide templates and guidance and examples of these kind of things, so you can have a look at what good looks like. But the business plan, our recommendation is a 20-page business plan in Word, not a PowerPoint deck. It's very hard to raise institutional money with the level of granularity and detail that a VC requires from a pitch deck. So a 20-page Word document business plan that's written tightly, that you've taken out all of the I think, I hope, I feels. You've taken out a lot of the wish list, and you've taken out the main other point that I edit out of documents almost every day is a long list of things we'd like to do in the future, which is an entrepreneurial mindset, right? We're going to do this, then we're going to do that, then we'll do this. We're going to roll up fully in the UK. We're going to double down on a channel sales strategy. We're going to open an office in Singapore. And that's kind of boiling the ocean. It's probably a little bit too much in there. And so what we would generally recommend is that you're able to drop that down into phasing and talk about phase 1 that links to this funding round. So phase 1, we're going to go from here to here. Phase 2, phase 3, become a paragraph on future development opportunities and not really majored on. The reason that's useful for you guys is by tempering your enthusiasm and only talking about the things that are real and relevant to the VCs in this round. You're not going to end up in a corner where they say, I'm looking at your plans to open an office in Singapore, and what's your international coverage? Have you got customers asking you to come to Asia? Who's your management team there? To which all your answers are going to be, well, no, not yet. We haven't really got any customers and we don't know anybody there. So now I think, well, that's not a very good answer, but that's an answer for your Series B round that you're not even planning yet. So condensing all of that into your 20-page business plan is a really useful exercise. You will find, and I see this 9 times out of 10, that there are business improvements made by writing the business plan, irrespective of the fundraise. So, for example, you pick up on potential contradictions in your own business, like we're assuming that new sales hires can generate £1 million of revenue each. Historically, our previous sales hires have generated sales of 300k each. Are we trebling the price? What does that do to our competitive positioning? Or are we just hoping that things get better and we hire people with a greater ability to sell volume than we've ever been able to achieve previously? So it surfaces things that give you, as a management team, the ability to kind of really think through, actually, is what we're saying plausible? Is it credible? And if there is a bit of a leap, then let's justify it. Let's explain why that's going to improve. Let's explain what's driving that change, because we know that a VC is going to ultimately find that point. So teaser, business plan, financial model. So this is back to the dark art of putting together projections, but you're going to need at least 3 years of monthly P&L forecasts. And you ideally want that to link to your existing current forecasts as well, so that your VCs can look at the trends, which is what they are. They're a pattern recognition machine. It's the way VC works as a sector. So they want to see that your revenue growth is based on the experience you've already got. And they want to look at that over the next 2 to 3 years in great detail. So why 36 months? This arbitrary suggestion of 36 months, 3 years post-funding of monthly P&L and cash flow forecasting. Well, essentially, if you think back to the role of VC, venture capital funding, it is there to deliver on an opportunity that you've spotted that you can't afford to go after from the current cash in the business. So the VCs are going to say, all right, we'll give you this money and we want it to work really, really hard, really, really quickly. Put it to work, make the hires, develop the product, build out the commercial strategy, sort out the go-to-market, go, 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 go. And it's fast moving. And so your VCs will expect you to have put all of their money, 5 million, 7 million, 3 million, whatever the number is, to work within a 12 to 24 month window. So that means you've spent 3, 4, 5 million pounds in a very short amount of time. But that's because the VCs aren't giving you the cash to sit in your bank account and be careful with. They want you to put it to work. They want you to move that business forward quickly and prove or disprove that your opportunity was right. And that is a slightly cynical approach to building a business, right? But it is the way VCs will think, because you might think, actually, I'll go more slowly and I'll gather the proof points gently and I'll hire carefully. But your VCs really want you to be putting your foot on the pedal immediately that cash goes into the business. And the reason for that, and therefore the reason for a 36-month monthly P&L and cash flow, which we all know will be wrong, but hopefully it won't be too wrong because you'll have thought through the assumptions and linked them to your previous proof points. But the reason for that 36 months is because for 24 of those months, you are burning the VC's cash every month. You're generating losses, 100k a month, 200k a month. Yeah, so big losses, and that's how you're spending that VC funding. Now those losses that you're generating are essentially the investment in the business. That is investing in the hope, the promise that your commercial plans will grow, that your product will meet the market demand. And that means that for 24 months, I, as your VC, if I was your VC, would be absolutely paranoid about, are you going to make this work? Are you getting those proof points? Is the traction there? Have you got enough runway? Now, after that, for the next 12 months, you've now hit break even, beginning to move into profitability. The top line and the bottom line are now both trending upwards. That's good news. But that still gives me a good idea of that 36 months, what your worst cash position is, what needs to be true for those numbers to be realized. And yet it still doesn't tell me anything about your ultimate value as a business on exit. So then an annualized view, sometimes you can do it quarterly, sometimes it's just as easy to carry on with your monthly forecasting all the way through to 60 months. But an annualized view for years 4 and 5 tells me that you're building a 30 million revenue business capable of creating 10 million of EBITDA. Now, at that point, I can model that a business like yours in your sector is typically worth 3 times revenue, 5 times revenue, 10 times revenue, 20 times EBITDA, whatever the number is. And I can begin to calculate an approximate exit value. And if I can work out the exit value, I can understand the entry value, which means I can now work out my return as a VC. And without giving them that 5-year forecast with that level of detail, they can't do the thing that they need to do as part of their job. They've told the investors in their pot, the investors in their fund, the target return we're going to look for this fund is 3x, 5x, 10x. And so without you giving them the numbers of your business, they can't extrapolate from that what the likely return is for their fund. So make it easy for them to say yes. So teaser to qualify out and get the no's, a business plan to really add the granularity, and a 36-month and then annualized year 4 and year 5 forecast of your financial model. And then alongside that, you're going to have two final points: pitch deck or decks. So what are you going to be saying to these VCs at the first meeting? How does that differ to the second meeting? How much information are you giving them up front versus how much information they're going to be allowed to read after they've met you? And that needs a bit of thought. And again, within the Venture Path community, we provide templates and guidance on pitch decks, plural. And finally, a data room. Now, at seed stage, you might not even have had to do this. This is essentially how to resource due diligence. Now, the VC landscape creates a whole load of awkward jargon. I fall into it now, having done it for a long time. But the due diligence is basically deep dive research into proving that everything you've said is true. Yeah, and that covers everything from HR issues to operational, technical, legal, commercial, financial, all those areas of your business. However, you can simplify that. This is all in the context of where your time is best spent. You can simplify that by starting now, today. Now, this could be something you do tonight, what with your laptop on your knees while you're watching telly. Right, this is boring work that doesn't need to distract you from your day job, but it does need to happen. I need to know that the IP was properly assigned 4 years ago when you built the tech. I need to understand that your key clients are locked in. I want to understand what the options you've granted to key hires. So pulling all of that together in advance means that when you are out talking to a VC and they ask you a difficult question, you can say, it's a good question. It's covered in slide 12 of the pitch deck. Let me just give you a quick overview of the org chart today and in the future. It's covered a bit more in the business plan. There's a chapter there on our HR recruiting strategy and the impact on the cap table. And there's obviously a folder in our data room that you could review with all of the details of the contracts. Now, that doesn't mean your VC is immediately going to say, yes, please, let me review your data room. It does mean they think, wow, this founder knows what they're talking about and they've made my life easy. And so they would be useful tips as to kind of where to spend your time. So think about getting your documents ready in advance. And then my final point, as Holly's probably flashing me for being out of time, my final point is just think about the importance of community in your fundraise. So getting quick and honest answers from VCs is quite hard for founders to do. A VC never really wants to say no to you. You might not be relevant, you might not be ready this time, but they don't want to say no and offend you and not see you in the future if they're looking for later stage opportunities. Some VCs, slightly disingenuously, will take a meeting to learn about your sector. I could go away and read a Gartner report, or I can have you in and you can tell me everything I need to know about HR tech. I want to know who the competitors are, what the landscape is. Oh, it sounds like an interesting sector. Lots of VCs will be interested in your business. That is not the same as lots of VCs being interested in investing in your business. Key distinction. There's a lot of time wasting goes on in the VC community because there are people whose job within a VC firm is to horizon scan, is to look for the opportunities of tomorrow, is to market map. And none of that is apparent when you're responding to an inbound inquiry, when you're approaching a VC and they take a meeting. And you start thinking, brilliant. Well, I've seen Berengier this week. I'm seeing Mobius. We're off to see YFM. We're in the market. This is going really well. And actually, none of the investors might be relevant for you or appropriate, but they're probably not going to give you that quick and useful feedback. So leveraging people who've done it before, people who know those VCs, people who can get you a quick and honest bit of feedback, can give you even blunt, direct advice. You know, we wouldn't do it because of this, but if you solve that, come back in 6 months when you have. He's got to be a better way of doing it. This is a once in a lifetime aspect of growing your business. You're never going to raise Series A again in this business because it's your first institutional fundraise. You might in a subsequent business if you're a serial entrepreneur, but you don't see even many serial entrepreneurs getting beyond 2 Series A's or 3 if they're into really going into a third business. So thinking that through and shortcutting it with the use of your board, non-execs, advisors, or obviously tapping into a community like Venture Path, which we've built, filled with VCs, filled with experts and exited entrepreneurs who do this kind of thing all day long, has got to be a useful shortcut for you. And that is probably all I can say in my half an hour-ish. So happy to answer any questions. but hopefully there's a few bits there you think, okay, that sort of resonates, or yeah, I understand why that's coming from.
Brilliant, thank you, Ian. I actually had one question that was shared with me, but if anyone else on the call has any, please pop them in. But we'll kick off with this one, Ian. You kind of touched upon part of it already, but it's around like use of funds, and also phasing. So, what do VCs expect? What do VCs expect to see in terms of like how you deploy that capital, and then also so how it's spent, but also over the time period. Over
Okay,
what
so
time period?
three answers. Time period, 12 to 18 months, typically 24 at a push, particularly if you're kind of a capital intensive business. That is a classic Series A timeline for spending their money. Secondary to that, I would say that the use of funds at Series A should be predominantly commercial development. So sometimes you have to massage the figures a little bit, he says, whispering, because if what you're looking to do is spend 75% of your fundraise on technical development product, it tells the VC that you haven't really found product market fit. Yeah, it tells them that the seed funding hasn't really created a tech stack that's fit for purpose. So whereas the goal of VC funding, if you come back to that objective, is to fund explosive growth in a business, easily 10x your revenue over a 5-year period as a minimum. If that isn't being communicated, then there will be a concern about, are you spending the money in the right way? So to get that to north of 50% being spent on commercial development is the goal. As long as that is genuinely the case. Now, there are two ways to do that. One, you can reclassify some of your titles. So marketing is part of commercial development. And you can break it down. You know, we're 60% commercial development, of which a third of that is marketing, a third of that is sales, and a third of that is account management hires. It could be that you focus it there. It could be that you reclassify some of the tech spend as client-driven commercial development. So or product development. So a client saying, if only you could do this, we would buy more licenses. We would spend more with you. That's quite a good bit of commercial development. You're explaining that there's some tech development, but it's needed to fill a commercial demand. And a final point on this is actually, if you are a majority tech spend, then you can, as a percentage, increase your raise amount. So if you're raising 3 million and 2 million is for tech development and 1 million is for commercial activity, raise 4.5 million, 2.5 million for commercial development, 2 million for tech, and see what that does to your growth plans, to your own confidence in being able to hit your forecasts. And then you've got a pie chart that is largely commercial development. So I would say 18 months is really where to aim for. Get that money spent, see the results of those of that activity, the funding that you've put out there, see what that delivers for the business in that short time period, and spend the money on predominantly a majority of commercial development. There's a final piece, which is, and don't forget to tell the VCs not only the tactical use of funds. This is something I see most founders fall into, this sort of bear trap. We're going to spend your money on these hires and doing this stuff and opening a new office and launching a new product. Great. As your VC, it's not very interesting. Good, I know that you're spending the money. Finish that sentence with the strategic use of funds, not just the tactical use of funds. In doing so, we will move from number 12 in our sector to number 3 in our sector. We will have grown our customer base from 50 customers to 500 customers, and that will position us as a market leader ahead of a prosperous trade sale. Using oversimplified language for brevity, but hopefully you get the idea that money moves your business into a different value proposition than where it is today, and that's perhaps a more interesting conversation for a VC around the use of funds than that you're going to be, you know, buying some new laptops for new hires.
Amazing. I did have a second one, but I don't want to take away from anyone who's on the call who wants to raise a hand or pop in the chat box. But I'll jump into this one. Ian, this is something we've actually been asked a few times and we've seen before around forecasting. And rightly to your point at the beginning when you said it's hard to predict sales. the kind of role of forecasting, and is it really necessary if it is going to be wrong?
Yeah, so we all know with the forecast, it's going to be wrong, right? It might be wrong in a bad way. It might be wrong in a good way. Don't know. However, the discipline required ahead of a VC fundraise is to have put together a detailed financial model with proper assumptions in it that say, here's the things that we believe, here's the things that we can prove, here's the things that we have gathered as much evidence as we can to demonstrate this is the more likely route. And if these things were true or broadly true, we create a big business that's much more valuable than the business we've got today. We can sell to more clients based on the characteristics we've already proven. We've been able to sell to these clients. Why can't we go and sell to more of them? We know there's demand. Because of that, we think that demand can tick up at a rate of 100% year-on-year growth if we're properly resourced and properly funding for the next 2-3 years. And then it drops down as more competitors pile into our market and our growth rate slows. And it's 50% growth rate year on year for years 4 and 5. Now, those kind of broad assumptions, properly modelled with the detail in the narrative behind why you're thinking that and what proof you've got, all adds confidence to the fact that although your forecasts are going to be wrong, they're probably not going to be terribly wrong. And then I would always sensitize them, and I would sensitize them and tell your VCs how you sensitize them. That said, we have accepted that not every sales hire will work out. So our efficiency for sales hires is 1 in 2, is 2 in 3, 1 in 3, whatever it is. That tells your VCs that you've sensitized the forecasting. So now they think, right, you've got a good team, you've got some early traction, you've got some key customers, you've got some good advisors around you. This is good as a starting point. You match our thesis, you match our sector, you match our life stage, and you match our ticket size of investment. With that in mind, let's really drill into the business and talk us through how you see the sales ramping up, how you see the product developing, how you see the market growing. And you've got all of that information, right? You're founders, you've got perfect market information. You're reading up on all of this stuff. You're thinking about it laying in bed at 3 a.m, like the weirdos that we are, right? So with all of that stuff going on, it means you are in a great position to say, this is the direction of travel of the market as told to us by our customers and our prospects. That's the opportunity we're going after with your funding. And there's a point that those numbers will change over time, but by forecasting them, you're really using that as an opportunity to do 2 things. 1, explain where the money's going and what it's likely to do. And also alongside that, being able to share cash flow forecasts of what your worst case cash position is so that they can see how much runway you've got, how you can adapt if the top line numbers aren't quite where you want them to be. But also, more importantly, I feel you're sharing with your VC your thinking process, and that thinking process is ultimately what they're backing, and that's the reason for some kind of necessity around forecasting that we all know is going to be wrong. It just shouldn't be guesswork. We'll try our hardest and see where it gets us to. That's fine when you're bootstrapping, right? That's how you start a business, but it isn't what VCs are looking for at this stage.
And that's it from me. So if anyone else has any questions, then please feel free to jump in. Ian, you've just come up. I can see you waving.
Other Ian.
Other Ian.
Ian to an Ian.
Hello.
Hi, Ian. Just a thought on pitching technology to VCs. So clearly a lot of founders are going to be technical experts because that's where they've come from. They've generated some tech. The VCs aren't going to be technical experts. What's your top tips on pitching the technology to a VC so they get it without bamboozling them, but they get enough confidence?
Yeah, it's a great question. And even when I meet VCs who claim to be tech savvy, they're not. They're generalists. Yeah. And then you've got the different challenge of a little bit of knowledge is a dangerous thing because they'll make all kinds of assumptions. We've got a business at the moment, one of the Venture Path community companies have just gone out to market in the last week or so to raise 5 million. And they have got some technology that utilizes commercial ChatGPT to guide call agents in call centers. And the first VC said, oh yeah, we've been looking at AI, applied AI, but ChatGPT is free. So won't people worry about putting their data into it? Well, that's right. ChatGPT is free as a consumer, but it's not when it's packaged in an Azure package and it's private data. So things like that, where the VC, it's very then tricky for the founders to say, no, you're an idiot, because you kind of want their £5 million, right? But to be able to say lots of assumptions around this, not teaching you to suck eggs, but here's an overview of what our tech does. If you'd like, we can happily show you a demo as to how a customer uses it, as opposed to how many lines of code, the tech stack it's in, all the nodes, all of those things. Too much detail. They'll come back to that. That detail will be necessary, but not at an early stage. So quite often, a demo, a walkthrough through a customer's lens with a talked narrative, either by you or a CTO, Chief Product Officer, who probably needs coaching and training up by you on how to talk to a VC, because otherwise they'll talk in their jargon that's familiar to them. But a high-level overview is a really useful way of doing that. You can preempt that in a deck with some screen grabs. Here's what it looks like, but I wouldn't ever share at this early stage in the process lots and lots of technical detail. Now, in the business plan, all they really want to know so if you think of these documents as different layers, so the deck is an overview. Yeah, it's a trailer for the movie. Yeah, you think, okay, yeah, I kind of get it. Yeah, there's that's the theme. The business plan is the movie. So then you've got lots of detail, and that's your opportunity to say within that, look, this is how it's been built. And broadly, the job of the business plan is to answer the question, one of three questions technically. Do we need to build it? Do we need to rebuild it? Or is it continual improvement? And so by answering that question, this is built and 100 customers are using it and love it. What we're using your funding to do is to add some whistles and bells that makes it more scalable. Yeah, that adds an extra revenue line to the business that our customers have told us they want. It's built, but it's built with string and sellotape. In our seed round, it needs to be rebuilt to be enterprise grade. And that's where the initial heavy lifting of the tech spend is going. They're the three layers. So we haven't built it. We need to build it. We need to improve it, or we just need to maintain it. And if you can answer that in the business plan in half a page, that gives the VC the confidence that, fine, it's built, it's not built, it needs to be built. And then continuing my weird film analogy, movie trailer, movie, and then the book with lots more detail, that's your data room. So in there is chapter and verse. That's where your CTO can put in all of their details of the lines of code and what's open source and what's proprietary and yada, yada, yada. But that is not for early on. Now, what happens in a VC's world is they'll profess to know all about what you're talking about, have no real idea, but be able to answer to their boss or their investment committee above them the fact that this is built, needs to be topped up. It doesn't need to be rebuilt. It's working, functional. It's just an ongoing tech overhead that they're funding in the future. Once they've answered that, they will probably outsource the technical due diligence to somebody who does know what they're talking about and can talk to your CTO. And at that point, they can have typically a very geeky conversation for a couple of hours and go away and write a report saying the tech is good. So it kind of doesn't really matter to the VC, and going down a rabbit warren with someone who is essentially blagging their knowledge in that space isn't a good use of anybody's time. But you can't not talk about it, because the whole reason your business commands the valuation you want it to have with a high multiple is because it's tech, and the tech makes it scalable. And so you can't be dismissive of the fact that you're a tech business or a tech-enabled business, but just keep it high level and present it initially through the lens of a customer, not a technician.
Thank you.
Yeah, okay.
Brilliant. Thanks, Ian. Well, we are at time, so we will leave it there today. But thanks, Ian, for hosting, and thank you everyone for joining us as well. Hopefully you found it a useful session. This is exactly the kind of support that we give one-to-one to all of our founders, so kind of much more personalised. So yeah, if this sounds like the kind of support that you're interested in, then I'll be in touch after, and we can have a chat. Thanks, everyone.
Thank you. Thanks,
Bye.
Neil. Cheers, guys. Bye.
Thanks. Bye.